Okay, quick show of hands in the comments. How many of you have ever looked at your 401k statement or your investment portfolio, saw it was up, and immediately thought, great, now I need to save even more to stay on track? You finally get a win, and instead of feeling richer, you feel behind. That's you, right? That was me for years. You hit a goalpost, and someone immediately moves it another 50 yards downfield. You get a 10% return. The financial news is screaming you need 12%. You finally save $10,000, and the calculator tells you you'll need $2 million to retire. It's exhausting. So you start looking for the shortcut, the one asset that doesn't play by those rules. And everywhere you look, people are screaming about one event, the Bitcoin halving. Supply shock. Number go up. It's programmed scarcity. And you're sitting there thinking, okay, but what does that actually mean for me? What do I actually do? Here's the thing. Everyone's talking about the halving's impact on Bitcoin's price. Nobody is talking about its real impact on you, on your brain, on the psychology that has kept you from building real wealth your entire life. Today, we're fixing that. My name is Henry, and I spend way too much time thinking about the psychology of money. If you're someone who's tired of financial goalposts that never stop moving, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Look, the narrative is simple. Every 4 years, Bitcoin's new supply gets cut in half. Basic economics. Lower supply plus steady demand equals higher price. The media, the influencers, they'll throw charts at you. They'll talk about stock-to-flow models. It's all math. And the math is important, but it's only half the story. Actually, it's less than half. The assumption they're making, the one that will lose you money, is that you will behave rationally, that you will just HODL calmly through 40% drawdowns after the halving because the model says so, that you won't get greedy at the top or panic sell at the bottom. That's a fantasy, and it's why most people don't make life-changing money in these cycles, even when they're right about the thesis. Let me hit you with a number. According to a 2023 study by the trading platform BitGet, analyzed by people like on-chain analyst James Check, a staggering 83% of Bitcoin investors have held their coins for less than 1 year. Let that sink in. 83%. The halving cycle is a 4-year event. The majority of people trying to play it can't even hold for one. They are trading around a slow-moving, tectonic, macroeconomic event with the attention span of a TikTok scroll. This is where it gets really interesting. The halving isn't just a code update. It's a psychological machine. It's designed to systematically exploit every single one of your financial biases. And if you don't understand that machine, you become the fuel for the people who do. Think about your first financial lesson, probably from a parent or a teacher. Money doesn't grow on trees. It's scarce. You have to work incredibly hard for it. Save it, protect it. Now, enter Bitcoin pre-halving. The narrative is pure, manufactured scarcity. The inflation rate is about to drop below gold's. The last 3 times this happened, look at this chart. It taps directly into that fear of missing out, FOMO, on a scarce resource. You're not buying a digital asset. You're buying a lifeboat on what feels like a sinking ship of fiat currency devaluation. But here's what most people don't realize. This FOMO peaks before the event. The halving is the climax of the scarcity narrative. And once it happens, the story changes. The halving happens. Block 840,000 gets mined. The news hits, and nothing dramatic occurs. Price might even go down. This is the narrative void. For months, the story was the halving is coming. Now the story is gone. The weak hands, the 83% heirs, they get bored. They sell. This is the accumulation phase for the patient. Then, slowly a new story builds. It starts with headlines. Bitcoin mining becomes unprofitable for inefficient miners. Then, Bitcoin's energy use is debated in Congress. Then, a major corporation adds Bitcoin to its treasury. The new narrative isn't about scarcity. It's about adoption. It's about utility. And this is where greed takes over. The price starts moving, not in a straight line, but in a staggering, volatile climb that makes the nightly news. Your brain, seeing this, doesn't think, yes, the long-term adoption thesis is playing out. It screams, Everyone is getting rich except me. The greed bypasses your logical cortex. This is when people take out loans, borrow on credit cards, and buy in at the absolute worst time. Now, you might be thinking, Henry, just show me the math. Tell me what price Bitcoin needs to hit for miners to be profitable. Give me a target. Fine, let's do it. Real numbers. Say a miner today has an operational cost of $30,000 per Bitcoin mined, electricity, hardware, cooling. After the halving, they instantly produce half the Bitcoin for the same cost. Their cost basis per coin doubles to $60,000 overnight. So the simplistic math says, price needs to be greater than $60,000 for miners to stay in business long term, or the network hash rate drops. But that's static. It's wrong. Here's the dynamic reality. The most efficient miners, with access to 3 cents per kilowatt hour power, might have a post-halving cost of $25,000 per coin. The inefficient miners at 8 cents per kilowatt hour get wiped out. The network adjusts. The floor isn't set by the average miner's cost. It's set by the most efficient miner's cost, plus a profit margin. So if the most efficient miner can survive at $25,000, the price can technically fall to that level without the network dying. This is why post-halving sell-offs happen. It's a brutal efficiency war. Think of it like a gold rush. The halving is the moment the sheriff announces, all the easy, surf is gold and this here river is gone. From now on, you need twice as much work to get the same amount of dust. The weekend prospectors with pans? They go home. They sell their claims cheap. The big mining corporations with industrial dredges? They buy up those claims for pennies and operate at a scale the little guy never could. The halving isn't a price trigger. It's an industry consolidation event. You, as an investor, are not a miner. You are a claims speculator. Your job is to buy from the panicked weekenders and have the conviction to hold for the industrial boom. So here's the real secret nobody talks about. The halving's most powerful impact isn't on Bitcoin's price in USD. It's on Bitcoin's price in time. Let me explain. You think in dollars. I want my $10,000 to become $100,000. The network thinks in security and decentralization. The block reward is paid to miners in Bitcoin to secure the network. When that reward gets cut in half, the network is saying, to keep the same level of security, the value of this reward, measured in the real-world goods, energy, and labor it can command, must remain the same or increase. The network demands a higher dollar price to pay for its own security. It's a self-healing feedback loop. If the price doesn't rise, miners quit, security drops, making the network less valuable, until the price finds a floor where security is worth paying for again. You are betting on a system that is economically programmed to seek a higher value, not because of magic, but because its survival depends on it. So what do? You build a plan that defends against your own worst instincts. This is when you feel FOMO. Your action is not to buy a huge lump sum. Your action is to set up a relentless, automated, bi-weekly dollar cost average, DCA. Take the emotion off the table. You are accumulating before the narrative peaks. This is when you feel doubt. Nothing happened. I was wrong. Your action is to double down on your DCA. This is the fire sale. This is when you deploy any dry powder you've saved in small, disciplined chunks. Your brain will tell you to stop. Your plan must force you to continue. This is when you feel genius-level greed. Your portfolio is up 300%. Your action is to have a selling plan written down now. Not a price target, but a principal target. Examples. I will sell 10% for every 100% gain after a 300% total return. Or, I will take out my initial investment when my portfolio hits 5x. You must have a plan to harvest profits, or you will become a permanent hodler through the next 80% crash, watching paper gains vanish. This is the most important step. You must denominate your wealth in Bitcoin, not dollars. Not all of it, but a portion. Stop thinking, when Bitcoin hits $X, I'll sell for a house. Start thinking, my goal is to accumulate 0.5 BTC. The dollar price is just a distracting noise. This mental shift is what allows the 17%, the long-term holders, to sleep peacefully. They aren't waiting for a dollar amount. They're holding a percentage of the total network, which is only getting scarcer. Look, the financial world is designed to make you feel like you're always behind, to keep you chasing, trading, reacting. The Bitcoin halving cycle is one of the only predictable macro rhythms in all of finance that isn't controlled by a central bank or a government. But they've convinced you to play it the same broken way. Reactively, emotionally, chasing the news. Don't let the narrative machine use you as fuel. See the halving for what it is, a 4-year psychological audit of your own discipline. It's not about outsmarting the market. It's about outlasting your own impulses. It's about finally being the person who buys when the story is boring and has the conviction to hold when the story is euphoric. The math says scarcity creates value, but your psychology determines whether you'll ever capture any of it. The halving is coming. The machine is starting up. Will you be the fuel, or will you be the engineer? Set your plan. Write it down. Automate it. And for once, let the moving goalposts come to you.